We've got a really important lecture coming up. We've talked about how economic growth must be strong and sustainable as part of the goal, but we haven't really talked about why this sustainability is so important. So, sustainability refers to two things. Sustainability. It refers to the achievement of low inflation, and it also means future generations' living standards, I'm just going to denote that LS, are not compromised. So this means we should not overutilize our resources that we have available. So what we're going to focus on in this video is how economic growth is related to inflation. And this is very important because as the government, they want to achieve the goal of low inflation as well as increase the economic growth. So if we look back to the circular flow model, we can see that economic growth arises. So economic growth, which is essentially production, it arises due to aggregate demand. And this is in the short term. I'm just going to put SR for short run. So in the short term, producers will produce what is demanded for by consumers. And we can apply this to an aggregate supply and aggregate demand model. So we've got the general price levels at pi, and we'll see y, which is also GDP. So what we want to do, or what the government wants to achieve, is that they want to move right across this line without affecting inflation so much. They want to keep inflation around 2 to 3%. Okay. So what we're going to assume now is that inflation, let's put a different color, inflation is achieved at pi 0, and this is 2.5%. So we're just going to call it, make it between the goal, the target range between 2 to 3% at 2.5%. And again, we have a short run aggregate supply curve, which is going to denote SRAS0, and we also have what is known as the long run aggregate supply curve, LRAS0. And we're going to see that this economy is in fact in equilibrium. So we do that line where aggregate demand, it's a bit tricky, aggregate demand here is at aggregate demand AD0. So at the moment, the economy is at equilibrium, and we can see that the output is a potential output at Y star. So everybody's happy. Short run aggregate supply meets long run aggregate supply, and aggregate demand meets the supply at this point. So what the government aims to do is that it doesn't want the GDP to be stable or constant at this Y star point. What it wants to do, or what it wants to achieve, is to increase its GDP to the right. And so to do that, aggregate demand, we're going to assume, has increased due to whatever government factors, or due to simply because of the business cycle moving from a trough to a boom. So we're going to see that the aggregate demand curve has shifted to the right to AD1. So as we can see, initially the economy was at equilibrium at point A. Now we move to a point B at this point here at aggregate demand 1. So aggregate demand will meet the short run aggregate supply. And as we can see, in the short term, economic growth has occurred. And this is due to an increase in aggregate demand. So the GDP rate has increased from Y star to Y1. But we must also note, however, that Y1, at this point at Y1, this also represents an expansionary gap. So what this means is that the economy has overutilized its resources. So economic growth, although in the short term hasn't really affected inflation, we can see that the economy has overutilized its resources, and that in the long term we can see that this will be unsustainable. So this part here, the sustainability part of economic growth, has not been achieved. So what happens is that producers will respond to this by in fact increasing their prices. And so the short run aggregate supply will just increase this graph a little bit. We can see that the short run aggregate supply curve will increase until it meets a new equilibrium. So I'm going to call this SRAS1. And this new equilibrium point is reached with an inbuilt rate of inflation of pi1, and let's call this around 5%. But it reverts, or GDP reverts back to its normal potential output rate. So economic growth may, in the short term, may occur, but in the long term, inflation will result if we are overutilizing our resources. So growth due to demand side conditions is potentially bad in the long run because of this inbuilt higher rate of inflation, which may compromise the sustainability part of the goal of strong and sustainable economic growth. So what we see here is that for the inflation rate to stay constant at pi 0, around 2.5%, we'll see that the aggregate demand line, we're just going to assume that the aggregate demand line has not changed. We're going to see a different analysis applied. Okay, look at this graph. I'll use a different analysis. So we have again the short run aggregate supply curve and a long run aggregate supply curve, and we have a downward sloping aggregate demand curve again. So instead of this time moving the aggregate demand curve to the right, we're going to move the long run aggregate supply curve to the right. So from LRAS 0, we're going to move this to LRAS1. So the potential output of the economy has actually increased. So in the short term, we will see that when inflation does not change, in the short term, producers will start to produce at this point right here. But because we are underutilizing resources, eventually the inflation rate will drop from SRAS1, SRAS 0 to SRAS1. So we can see that once the long run aggregate supply curve shifts to the right, economic growth would occur, would increase from Y star to say Y2, and the inflation rate would decrease from pi 0 to pi 2. So that's economic growth, and that's how economic growth and inflation are related. So if we're going to write this out, we're going to see that when inflation, sorry, not when inflation, but when economic growth is unsustainable, inflation will increase. So economic growth due to aggregate demand increasing is unsustainable in the long term, which will then build in a permanently high rate of inflation. However, when economic growth occurs due to increases in potential output, then this is good for the economy, and the inflation will be kept in check. So that's the relationship between economic growth and inflation. Sometimes when economic growth is so quick, inflation may occur. However, if economic growth is determined by supply, and that inherently our supply side factors have improved, then inflation, or the goal of low inflation, would tend to have been achieved.